Hey, it's Matt from Financial Sense, the #1 accounting practice management software. And it's not just back to school season, it's almost time for yet another busy season for your firm. But we know that no matter how much work you have to do, the world of accounting keeps spinning on. Don't worry, if you've missed the latest industry news, we're here to help. And we're back with the latest episode of the only show that asks the question, what's new in accounting? Brought to you by Financial Sense. First up, we've got to talk about Accenture and what its massive profits and losses earlier this year might actually mean for accounting. In June, one of the biggest consulting companies on the planet lost almost 20% of its stock value in a single day. Not because business was bad, but because of one term investors keep hearing everywhere: AI. And if you bill clients by the hour, this story isn't really about Accenture, it's about you. See, Accenture shares sank about 18% on a single Thursday in June, the stock's worst single-day drop in years, after the company reported earnings for the quarter that ended on May 31st. By that point, Accenture's stock had fallen more than 50% for the year. Here's the part that you should pay attention to. The quarter itself actually looked healthy. Earnings per share rose about 9% year over year to $3.80. Revenue grew 6% to $18.7 billion, with operation margin ticking even higher. The business wasn't broken. Investors weren't punishing the past. What they were doing was actually pricing in fear about the future of the company. The trigger wasn't the results. It was guidance caused by Accenture trimming its full-year revenue growth forecast to 3 to 4% in local currency, down from 3 to 5% range it had given just 3 months earlier. That's small on paper, but for a $70 billion company, even a half a percentage point signals real softening demand. And then there's the number that really matters most for this story: new bookings, which is the clearest signal of future revenue. New bookings slipped to $19.3 billion, down from $19.7 billion a year earlier. Consulting is a pipeline business. When the pipeline shrinks, that's not noise, that's the future telling you something. Maybe for some, the future is saying El Nino is coming, invest in umbrellas. But for Accenture, it was saying people want something different. What's really telling is that consulting revenue specifically grew just 1% in local currency last quarter in the segment of Accenture's business that's most exposed to exactly what AI is good at automating. To be fair, Accenture pushed back hard on all the doom and gloom. CEO Julie Sweet said on the earnings call, "We believe that AI will be a tailwind for us and our industry as it scales," arguing that AI actually creates more demand for Accenture's services because helping big enterprises deploy AI across their operations is messy and expensive work, and it's exactly the kind of project that Accenture sells. The company had booked $2.2 billion in what it calls advanced AI work in an earlier quarter, and has since stopped even breaking out that figure separately, saying AI now runs through nearly everything it does. Even the CPA-focused analysis of this moment agrees that AI bookings growth was real. Accenture's AI bookings actually grew 53% that same quarter, even as the market reacted like the sky was falling. So, which is it? Big demand for AI or a showdown for accounting support? Well, it's probably both, actually. And that's exactly why the story matters more than a simple headline saying, AI is killing consulting. Don't clip that. Here's the sharper read, and it's the one that should actually change how you think about your own firm's pricing. The market's reaction points to something narrower and more durable than a general AI panic. Companies have stopped paying for hours the way they used to, and that same math is coming for every accounting firm still billing compliance work by the hour. Think about what Accenture actually sells for many of its clients. It's help in building software, integrating systems, and producing accurate deliverables under deadline. That's not fundamentally different from what a lot of compliance-focused accounting work is. Filings, reconciliations, and reviews produced correctly and on time. For decades, that kind of work was billed by the hour because producing it took real, scarce time. AI now produces that same information fast and cheap. And it's not the production itself, not the professionals who used to sell it, that's disappearing as a paid service. That distinction matters. Nobody's saying accountants are going to become obsolete. They're saying the thing you used to charge for, hours spent producing an accurate answer, stops being worth as much once a machine produces the same answer in seconds. So, what's left to sell? The framing worth stealing here is the shift from an answer economy to a question economy. Firms used to sell correct, timely, defensible answers to questions clients already knew to ask. What clients need now, and what AI cannot manufacture, is someone asking the question they didn't know they had. That's a genuinely useful way to explain advisory work to a partner who's skeptical about pivoting to advisory as some vague buzzword. I'm going to tell you right now, it's not that vague. It's specific. Noticing a client's business needs that nobody assigned anyone to find, then bringing it up to make sure a huge issue doesn't hurt the company is really important. So, why does this matter for your firm? You're not Accenture, but the mechanism is identical, just at a smaller scale. If a chunk of your billable hours is spent producing information a client could soon get faster and cheaper from an AI tool, that revenue is exposed, regardless of firm size. The firms that will hold up are the ones already building advisory relationships, where the value is judgment and proactive insight, not just accurate output delivered on time. Notably, the share of firms offering advisory services climbed from 83% to 93% in a single year, and firms most active in AI adoption posted the strongest advisory growth of all. It's not a coincidence, that's the market already making the shift that Accenture's stock chart is warning everyone about. Think about how you can start making that shift too. Next, a private equity giant has just closed a nearly $3 billion deal for a piece of a top 20 accounting firm. Let's talk about what happened with Crowe and KKR and why this deal matters even if you've never worked at a firm anywhere near this size. Chicago-based Crowe US completed the sale of a stake in the firm to KKR on August 7th, making it one of the largest US accounting firms to receive a private equity infusion. The deal was first announced back on June 11th, so this wasn't a quick handshake. It took about 2 months to actually close. According to IPA's 2026 Top 500 ranking, Crowe is the 12th largest accounting firm in the US by revenue. KKR, alongside investors, agreed to acquire a majority of Crowe US in a transaction valued at nearly $3 billion. One of the biggest private equity into accounting deals to date. Crowe's own partners will retain a minority stake going forward. For scale, Crowe has more than 9,000 employees and generates around $1.4 billion in annual revenue. So this isn't a small regional firm dipping a toe into outside capital. This is a firm in the top tier of the profession, fundamentally changing who owns a piece of it. Here's the mechanical detail that actually matters if you're trying to understand how these PE deals work at all. With the completion of the transaction, Crowe Advisory LLC will provide tax, advisory, and other non-attest services, while Crowe LLP will remain a licensed CPA firm and continue to provide those services, including audits and reviews. Both entities keep serving clients under the Crowe Global Network. That means KKR's money didn't buy the audit practice. Actually, it couldn't. Regulators don't allow outside non-CPA ownership of the part of the firm that signs off on audits. So firms taking private equity money split themselves into two entities. The audit shops stay independently owned by CPA partners, and a separate advisory arm for tax, consulting, and everything that isn't attest work takes the outside investment. If this sounds familiar, that's because it's become the standard playbook. Crowe joins a group of top 15 firms that have already received private equity backing, including Baker Tilly, Grant Thornton, Cohn-Resnick, and Eisner-Amper. Crowe's leadership framed the deal around growth and technology, not survival. Co-CEO Steven Stramello said, "At its core, this strategic partnership is about staying ahead of what our clients need and making sure we're equipped to deliver. Crowe has strong strategy and real momentum, and this investment helps us take the next step. KKR's support will go toward deeper investment in people, capabilities, and quality." But in an interview with the Wall Street Journal, Stramello was more direct about the pressure driving this. It shouldn't surprise you that the new capital will help the firm accelerate their AI adoption, boost its capabilities, and let it acquire more firms. He put it plainly, "The whole competitive landscape is just transforming much faster than I probably would have predicted a few years back." This isn't just "we want to grow," it's the pace of change got faster than we expected and we need outside capital to keep up. From KKR's side, this is about buying into an already strong platform rather than fixing a struggling one. KKR partner Chris Harrington said, Crowe has built an outstanding business with deep industry expertise, trusted client relationships, and a clear strategy for continued growth. Our investment reflects confidence in the Crowe team and many compelling opportunities ahead. The investment came through KKR's North American Fund 14, one of the firm's dedicated vehicles for exactly this kind of mid to large cap deal. This was deliberate, targeted bet on professional services as a sector. Looked at from a distance, the Crowe KKR deal is part of a much bigger story about how fast the accounting profession's ownership structure is changing. The wave of private equity buying into accounting firms began back in August 2021, when Towerbrook Capital Partners took a stake in EisnerAmper, the very first PE investment in a top 20 US firm. And the deal established the two-entity template that Crowe is now following 5 years later. Since then, it's been a steady cascade. New Mountain Capital bought a majority of Citron Cooperman in 2022, Parthenon Capital backed Cherry Becker that same year. Hellman and Friedman and Valeas Capital Partners put roughly $1 billion into Baker Tilly in 2024, and New Mountain came back weeks later to invest in Grant Thornton. Crowe is simply the newest investment, and one of the largest names on that list. Interestingly, Crowe was originally in exclusivity talks with KKR back in April at a price of about $2.5 to $3 billion, noting Crowe generates about $225 million in EBITDA and serves more than 500 private equity clients, managing over $250 billion in assets. So in a bit of irony, one of the biggest reasons that the firms wanted a piece of Crowe was that Crowe already had deep established relationships serving private equity industry itself. KKR wasn't just buying an accounting firm, it was buying a firm that already understood exactly how PE firms think and operate. But you don't need $3 billion of outside capital to feel the effects of this trend. Every time a top 15 firm takes private equity money, it gets more capital to spend on AI tools, marketing, and acquiring smaller firms, which raises the competitive bar for everyone below them. Firms that can't or won't take outside capital still need a way to compete on efficiency and client experience. That's exactly where smart workflow and practice management tools stop being nice to have and start being the thing that keeps a mid-sized or small firm competitive against PE-backed giants throwing money at the same problem. Okay, let's take a quick break. With all this talk about the latest and greatest and scariest in the world of accounting, it's easy to forget that accounting has been around for centuries. And when you look back at the foundations of modern accounting, you have to go all the way back to the 15th century and one Italian friar who never even knew the word QuickBooks. And maybe that's for the best. His name was Luca Pacioli, and he was born in 1445 in a small Tuscan town, basically the exact moment the Italian Renaissance was popping off. Da Vinci painting things, Michelangelo sculpting, sculptures and stuff, and Pacioli looking around all this artistic genius and saying, you know what all this needs? This Renaissance that we're in? They didn't really actually call it the Renaissance in the middle of it. It needs better spreadsheets. What a visionary. Pacioli would move to Venice when he was young to work for a wealthy merchant. So basically, he was an unpaid intern. While there, he picked up the trading practices of Venetian merchants, who needed a real system for tracking international trade. And he even went on to meet Leonardo da Vinci himself in Milan in 1496 while teaching a court that da Vinci happened to be sitting on. And somehow, they became close friends. They even collaborated on a book together, La Divina Proporzione. It's a mathematics book focused on proportions, and Da Vinci even did the illustrations. So the same time that the hands that painted the most famous smile in human history also doodled diagrams for an accounting book. Incredible use of talent, honestly. But Pacioli's biggest contribution was writing the Summa de Arithmetica, a massive summary of all known math at the time: arithmetic, algebra, geometry, and tucked in there, the first full written description of double entry accounting. Assets, liabilities, income, expenses, trial balances. All the greatest hits of your Monday morning are sitting right there in this 500-year-old book. And even way back then, Pacioli knew what was up, stating that the hardest part of double entry accounting was getting your debits and credits to actually match, and that you shouldn't rest until you do. Pacioli, my man, some of us are still not resting. Some of us are up not resting right now. Here's the twist, and it isn't just a funny historical footnote. Economists genuinely argue that the free market capitalism as we know it couldn't have spread across Europe and North America without Pacioli's system. Once merchants could actually track whether they were making money or torching it, businesses could scale past, trust me, I got it. So next time double entry bookkeeping feels tedious, remember, this is the operating system underneath basically the entire global economy. No pressure. And for our final topic of the day, if you have a senior position in public accounting and are wondering why your paycheck barely moved since you were an associate, you're not imagining it, and new data has just confirmed that you're not alone. And if you're a firm owner wondering why your seniors keep walking out the door, this same data explains exactly why. Let's break down what's actually happening with public accounting salaries right now. Recruitment firm Distinct just published an analysis pulling from more than 400 public accounting placements completed across North America over the past 3 years. This isn't a survey where people self-report what they think they earn, it's actual placement data, covering hiring activity from associate all the way to partner across boutique, mid-size, and top 200 CPA firms in 24 US states, Washington, D.C., and Ontario. The big finding is that salary progression in public accounting doesn't follow the steady, predictable climb that most professionals expect. Instead, it slows considerably at the senior level, then jumps significantly once someone moves into management. In New York, average associate salaries reached $105,000, with just $108,000 for senior tax and audit professionals. In most firms, that's the promotion that's supposed to represent a real jump in responsibility, including a new title, new expectations, and more client-facing work. And the pay difference is under $3,000. New Jersey showed a similarly modest bump, from $92,000 at associate level up to $99,000 at senior. And across the wider data set, senior tax and audit compensation generally stayed clustered between roughly $90,000 and $110,000, regardless of your market. Aran Jaiswal, director at Distinct, put it plainly. The assumption is often that compensation in public accounting progresses steadily year after year, but increasingly, the real acceleration happens once candidates reach manager level. If associate to senior barely moves the needle, senior to manager is where the real jump happens. Average manager salaries hit $146,000 in Connecticut, $140,000 in Virginia, and $138,000 in New York, significantly steeper than what seniors saw when getting promoted from associate. The logic tracks. Firms appear willing to pay a real premium once someone takes on genuine responsibility for client relationships, staff development, and business performance. That's the stuff firms believe actually drives revenue and retention, rather than technical execution alone. At partner level, the range widens even further, from roughly $148,000 to more than $270,000, reflecting how much firm structure, market, and leadership scope vary once you're at the top. The New York numbers in this data are a nice little case study in how misleading the market pays well can be as a blanket statement. New York associates and seniors are separated by less than $3,000, but New York managers are pulling in nearly $139,000. Same city, same firm, wildly different story depending on which rung of the leadership board you are standing on. If you only look at starting salaries when benchmarking your own firm's pay, you're looking at the one data point that's least useful for understanding where people actually leave. Here's a detail that matters for anyone doing the hiring. Associate salaries were remarkably consistent across firm sizes, averaging between roughly $81,000 and $85,000, whether you're at a boutique shop, a mid-sized firm, or a top 200. Firm size basically doesn't buy you a pay advantage at entry level anymore. That's a real implication for how firms are competing for young talent. If everyone's paying roughly the same starting salary, the competition for early career positions is happening over something else, like development opportunities, culture, flexibility, and a visible path forward, not the number on the offer letter. One more shift worth knowing. The traditional hub versus everywhere else salary cap is closing, at least for experienced professionals. States like South Carolina, Colorado, and Tennessee are increasingly offering manager and partner level compensation that rivals the big established accounting hubs. Jaiswal's reading on this. Secondary markets have become far more aggressive in how they compete for experienced talent. Firms outside the traditional major hubs know they have to be competitive once candidates reach leadership track positions. If you're running a firm outside a major metro and assume you can pay below market because you're not in New York or Chicago, that assumption is getting riskier by the year. This data points straight at your retention risk, and it points at a specific stage, the senior level. That's exactly the point in someone's career where they've put in a few years, built real technical competence, and are eligible to sit for the CPA exam or have already taken it. And looking around, wondering if the jump to the next level is worth staying for. If your firm's pay structure mirrors what this data shows, a flat stretch at senior before the manager pay finally jumps, that flat stretch is precisely when good people start returning recruiter calls. The fix isn't necessarily pay seniors more across the board. It's making the path to manager visible and fast for people who deserve it, since the data suggests that's where the real financial reward and the real retention layer actually is. If your firm has a clear enough path from senior to manager, that's the kind of visibility and incentive that will keep the good people from quietly job hunting while you believe that they'll stick around for years. Alright, I think that's enough industry news for the day, and now that it's time to get back to work, you might be wondering how you might be able to make the rest of your workday easier. Well, Financial Sense might be the upgrade that you need. It's an all-in-one accounting practice management platform that's helping more than 10,000 accounting and bookkeeping firms manage their workflows, seamlessly collaborate with clients, collect payments, and so much more. Here's just one Financial Sense feature that firms love: the month-end close. Instead of dealing with countless hours of tedious work to close the books, month-end close helps firms quickly sort out uncategorized transactions, collect W-9s as needed, generate reports on unusual transactions that need their needs, and so much more. It's just one of the many features from Financial Sense that's helping firms make the most of every day. Want to know more? Click the link or scan the QR code, and thanks for watching What's New in Accounting.